Hello and welcome, and in this stock analysis video I will share with you my simple investing process which has helped me get a consistent return of over 20%. So in today's stock analysis we're going to look at Microsoft. First, let's find out about the company. Microsoft was founded in 1975 and then was later IPO'd in 1986. Microsoft develops and supports software, services, devices and solutions worldwide. During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results, we'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarize our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. Earnings per share is 19% for the trailing 12 months. Now let's look at the free cash flow, which is the money a business can generate from its operations. Free cash flow is also up by 19%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Revenue is up by 12%. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. Book value looks great at 23%. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. Return on invested capital and return on equity is up by 26% and by 34%. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. Debt can be paid off in just over 1 year. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. And gross margin is very healthy at 70%. Next we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. Operating profit margin is excellent at 45%. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for a company that has a free cash flow yield of 5% or higher. Free cash flow yield is looking incredibly healthy at 5.51%. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years. This is 19%, with its lowest point being 12% 10 years ago. Ben Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is 41%. I have included a link if you want to check out the investors page and see the annual report. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. There are currently 12 super investors who own this company, and if we look back at Joel Greenblatt's previous sales and purchases, we can see he has both bought and sold shares in Microsoft in the last few years and has increased his stake in the last quarter. He has 82.2 million invested in Microsoft, and this makes up 1.28% of his overall portfolio. However, 20 other super investors have sold shares. Terry Smith has consistently bought and sold Microsoft over the last few years. He has 3.25 billion invested in Microsoft, and this makes up 12.87% of his overall portfolio, so he just seems to have trimmed his stock. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. If we look back at the past performance of Microsoft, we can see from 2014, Microsoft have generally increased year on year, although they were a little flat in 2021 and 2022. On average, the analysts believe that the price target should be about $464, but some believe it can go as high as $600. Analyst reports suggest that Microsoft is probably at fair value at the moment, and the overall consensus is that Microsoft is a strong buy. And collectively, the analysts believe that the company will continue to grow at about 15% over the next few years. So I'm going to use the current earnings per share at 11.53 as my starting point when creating a valuation. Based on a combination of past growth and future analyst predictions, I'm going to estimate the earnings per share will grow about 20%. I'm going to give Microsoft a PE ratio of 25. After that, I'm going to project these numbers forward by 10 years. This gives me an estimated future stock price of $1,785 per share for its future share price. Then we need to include our 15% return and work out the current value that Phil Town calls the sticker price, which is $441. Then we apply a margin of safety. At 50%, it gives me a buy price of $220 per share. And at 25% it gives me a buy price of $330. As we can't rely on just one valuation model, I'm going to dig a little deeper and gather some more information. If you found this video useful, click on the link to check out my last stock analysis. Based on the book The Lunchtime Trader, I'm going to split the 5-year stock chart into 4 zones to determine the current movement of the company and to help identify key indicators such as when to buy and sell the stock. Our first zone is the market bottom for Microsoft, which is about $135. Then we come to zone 2, which is between $225 and $315. And then zone 3 is between $315 and $399. Finally, we currently seem to be in zone 4, which is over $400. If you are wanting to buy and hold and believe that Microsoft will continue to increase year on year at even 10%, buying at today's price will give you a great return, but only if you are prepared to buy and hold for the long term. The return we would receive if we had bought at the 52-week low of $309 and sold at the market high of $430 would be 39%. We could see a return of 30% if we bought at our margin of safety price of $330. Microsoft have established themselves as the #1 company for providing an operating system for PCs and laptops, but have created many other products which have widened their moat over the last couple of decades. Microsoft Office and Windows brings in about 32% of their yearly revenue, but they continue to develop and improve their portfolio of products. Recently, their commitment to innovate has seen them rapidly improve OpenAI, and they have looked to embed this technology into their suite of products, which will again future-proof the company and increase their monopoly over other companies. Microsoft is an incredibly well-run company as their key pillars keep improving year on year. In addition, the current management are making excellent decisions with regards to the company's direction and vision. If you've enjoyed the video, it would be greatly appreciated if you would like and subscribe to help the channel grow. And finally now we'll summarise what we found out about the company. When reviewing the key pillars, Microsoft scored 12 out of 12. Under ownership, 12 super investors have bought in the last few months, whereas 20 have been selling. The past results show that we are currently in an upward trend over the last 10 years. Analysts are indicating that Microsoft is a strong buy and they're predicting they will grow between 15 and 20% over the next 5 years. Using the different valuation models, my personal buy price would be $330 or less. Microsoft have a wide moat and it's believed they own about 21% of the market. My final overall rating is 4 stars out of 6 and I've given this a category A star rating within my own stock watch list, as many of the key metrics are incredibly good and the revenue and earnings are increasing year on year. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comment section to help me develop the content I am creating. And don't forget to like and subscribe.